Welcome everybody. While we're waiting for other people to come on in, if you feel like it, if you could put your name and where you're from, or we actually have your name, I guess, and where you're from. It'd be fun to see where everybody's coming in from. So.
Yeah, if you want to just write in the chat. I'm Jacqueline, by the way. We'll introduce ourselves in just a second, but in the chat of Zoom, we just love to see where everybody's tuning in from. See, some of you are driving, so obviously that does not apply to you, but otherwise let us know.
Cool.
Just as people are jumping in too, we'll go over just a few logistical things. At some part of the night here, we're going to go over what we call a haves once. It's something that we do on every monthly meeting. Gives people the ability to stand up in the call, in essence, and talk about where you are today, what you're looking for. Gives a little bit of the ability to collaborate with others on the call. So just make sure you unmute yourself when you're ready to do that. Give yourself kind of that raise hand emoji down on the reactions button in your bar. That just lets us know that you're ready to or interested to come speak. And then anytime during the night, if you do have questions, feel free to drop them in the chat. We will do our best to keep it open here on our screen so that we can answer them along the way.
Cool. What are we at? We are at 5:02. What do you say? I think we should get started. So first of all, I want to just do a quick introduction. I have with me tonight two of our team members, key players in everything that we do here, Jacqueline and Kyle. And so I'm going to let you guys introduce yourself a bit, but our goal is to have almost like a mini, I guess I'd call it a mini panel or
a little bit of a role play.
Fun discussion session here. You have some role playing and whatnot. So Kyle, do you want to introduce yourself?
Yeah, so Kyle, just a strategist on the team here with Tom at GCA. Same with Jacqueline as well. So if you want to say hi, Jacqueline.
Hi, Jacqueline. Yeah, we're often behind the scenes, but we do a lot of the front-facing communication with investors or would-be investors. So we're going to go over in just a second the focus of the call. And since Kyle and I have a lot of experience talking to investors, we know the kinds of common questions investors ask on our end. So we have a frequently asked questions list. We're going to be doing a fun role play with Tom to unveil what a lot of those are. And also from our perspective, and I'm sure a lot of you can relate to this, you can tell when you're communicating with a savvy investor on the other end based on how we perceive they stress test the deal. So we'll get into a lot of that good stuff.
Yeah, and I think the important part about tonight is we understand there's a lot of people on the call from different areas of real estate investing, right? So you could be an investor looking to use money to invest in deals. You could be a project owner who's seeking the money and looking to have those phone calls or interactions with investors. And Tom, I understand there's even some sellers on the call too. So all of this will play a role and we'll try to attack this from different perspectives so that anybody on the call this can apply to.
Great.
Okay. So a little bit about what we're going to go through tonight. Again, just welcome everybody. We do these every single month. So these happen on the second Tuesday of the month. And typically you'll start getting invites about a week prior to them. In order to stay on that invite list and really be a part of what we call the Investors Club, as this is the Investors Club meeting, I understand that some of you are probably already in that group. If you're not, you can go ahead and sign up and we'll go ahead and drop the link in the chat here soon. It basically takes 2 minutes. It just asks a number of questions in terms of compliance reasons. And the purpose of the group really came out of, which I'll cue you up in a second, Tom, to talk about the Bay Area Investment Club that you started. But the purpose is really twofold, right? It's getting on the calls here on a monthly basis to talk about real estate opportunities, trends, values, right? Things that matter, practices we can put in place, what to look out for, what to stay away from. The second is more of why we ask those questions. There's about 4 questions to be able to join the club, and it's totally free. And it's because we serve up a deal of the month from our pipeline here at GCA directly to your inbox. So again, to stay within compliance reasons for the SEC, making sure that we have those multiple touch points. That's the reason that we have this select group of investors so that if you're interested in seeing those deals to participate in, you can compliantly get those along the way.
Cool. So enough of talking about what we're going to talk about. So how about we just, should we get started here? What we like to do when we start these meetings is have a haves and wants session. Well, first of all, back to what you said, Kyle, one of the reasons I started the meetup group back in 2010, and this was the Bay Area Private Money for Real Estate Investors group, was that there was a lot of people looking for money at that point. A lot of people that had deals, they were looking for money, and so private lending or private money investing was a key piece to what was going on at that time, and it's only gotten stronger since. So what we did back in 2010 started basically out of a small restaurant, had about a half dozen people, and over the years we did this sort of a meetup or a meeting. It's not really a meetup anymore, although we have a lot of meetup members on it now. But we had, where was I going with that?
Well, Tom, you transitioned it. I mean, obviously, because of the pandemic, it was an in-person format a lot of the time, which naturally had to adapt. So a lot of this has been moved to a digital format to still give the ability for people to collaborate.
That was my point.
I know how to end your sentences, Tom. Yeah.
Thanks for carrying that for me. So, and one of the biggest reasons for the success, I think, was that we had the haves and wants session early on in the meeting where anybody could get up, and at that point it was in front of the room with a mic. So this is probably a little less intimidating for some if you guys are camera shy like I am, or audience shy. And so what we're going to do is we're going to open up the what do we call it?
The line.
Open up the line for whoever has something that has something that they are willing to share with people, a service or a project or something like that, or if there's something that you need for your business to be able to grow your business. What I'd like to do is try to limit it to about 30 seconds, maybe 45 seconds per person, so that gives us plenty of time as we roll forward. So I am recognizing a lot of names here. Terry L, welcome, good to see you on the call. George, good to see you. Alex. So it's really cool to see a lot of familiar names and faces. So thank you for joining this call. So with that, how do we want to do that? We want to have them raise their hand.
Anybody just goes down to the reaction button in the bottom of your bar. You'll have the ability to raise your hand. That'll just indicate that you're ready to kind of step into the room, unmute yourself, and then kind of go along that way.
And if that's too much of a hassle, just wait.
Yeah. And just one last quick reminder before we do this. Again, this is all about sharing where you are, what you're seeking, but so that we're all remaining in compliance, right? What we all have to do with an SEC. This isn't about pitching, right? So sometimes we have to stop people to stay away from that. Let's just keep it very general and then open format.
Cool. So we have a couple.
So we have a couple to go. Dara, how about we kick off with you?
Hi, good afternoon, everybody. Let me lower my hand. Learning this new Zoom world. Happy New Year. So I'm here to learn more about investing, and I put my email in the chat if anybody wants to keep in touch, because I have some pretty exciting things on the horizon in the way of film production, but I'm also curious about real estate. So thanks for hosting this.
All right,
Fantastic.
Thank you and welcome.
And Dara, just a quick question for you. Are you looking at investing money into real estate? Or are you looking at acquiring property? Just for everybody on the call, where you're investing in.
You said, what was the last part of the question? I'm sorry, I missed that part.
Acquire a property and then find investments for it. More of the active and passive.
It would be awesome to acquire a property.
Fantastic. Thank you.
Okay. Thank you.
Guru, we have you up next.
Hi, my name is Guru Tur. We just contracted and closing on a fourplex in Porterville. So right now, I was looking for money, but right now I have a private lender funding. I don't like the terms, but it's funded now.
Mm-hmm.
So yeah, and right now I'm looking for a GC. I've had 2 GCs go by the property, one from Bakersfield and one from Fresno. I would prefer a GC nearer to Porterville, in case if you have any referrals. I'm also looking for, if I need, eviction attorney. Now this is a long-term play, and I'm going to be getting back to Tom, we intend tearing down this whole complex in a year and a half, once we have all the entitlements in place, and then build up probably a condo or an apartment complex. It's fairly good lot size. And East Porterville, the city intends helping develop East Porterville. So right now I'm looking for a GC if you have any, and any eviction attorneys if you have any, you could reach me.
Great, thank you for sharing. And do you, you can either type it in the chat or you can recite how people might reach you.
Okay, I will type it in my in the chat box right now.
Okay,
Great. Thank you, Guru.
Sounds good.
Thank you.
You bet.
Okay.
All right.
Anybody else wanting to jump in?
George, you got anything? Teriel, you looking for projects? Anybody? Eddie? Hey, Rosalind, good to see you on the call as well. So,
you know what? Boaz Capital Group shifted into multifamilies once COVID hit it back in 2020.
okay.
So now my question might be out to the group. We're trying to buy wholesale. We're trying to find wholesalers. Maybe if there's any on the group that know wholesalers or are wholesalers for multifamily, maybe I can put my email, they can get back and we can discuss how I can help them as well, how they can help us.
Excellent. Excellent. Great. Good luck on that, George. And if anybody is would rather not share their information verbally, you're welcome to put whatever information you have that you want to share in the chat. So one last call for was that last hand up? Is that one done?
While you're looking for the hands, if anyone does want to type in the chat, I just want to ground one more time what this is for. So Halves would be a great place for you to share your connections, what you love to do, how you can help others, or any kind of information that would support people to know why they should contact you specifically. And wants is then something you're pulling in, something you're looking for, a resource. A lot of you guys gave great examples there, the last one being a wholesaler contact. So if you want to ask for haves and wants in the chat, go ahead, and otherwise we're going to move forward. Thanks for participating.
Cool. Good. Yeah, let's jump into the next.
Great. So really the theme of the night, just to reiterate it, is going to be, again, looking at this from both a passive and an active investor side. Being able to prepare to know what to look for when having those conversations about seeking a deal that you want to invest in. Or on the reverse side, right, if you are a property owner, a project owner and seeking the money, what you should be prepared to answer from investors so that it sets you up to win. Now, some of this may be, as you were going through this, things that you have in place already. I'm sure many of you on here are already experienced in doing this actively. So this is really just a general forum, right? And we encourage anybody, if you do have questions in the chat for us, right, as if you're an investor or a project owner and want to know how we at GCA would properly answer those, please feel free to do so. So again, this is going to be looking at it from a dual perspective. And with that, we can kind of just jump in. So
we're going to start with grounding
Correct.
into the new deal. Yeah.
Yep, absolutely.
So we're going to be illustrating our latest opportunity and using it as the foreground of what we're going to ask and inquire about. So
The role playing.
the role playing. So as we screen share the opportunity,
Yeah.
we're going to have the terms blacked out. I
Yeah,
just wanted
because
to.
this is not an offer.
Right, this is not an offer. And if you are a member of the Investors Club, you will be receiving the deal summary without that blacked out as soon as this call is over in your inbox.
And again, the reason for that, the reason for the blacking out, and the reason I say it's not an offer is it's all about SEC compliance. We just want to make sure that we're not, because this is open to the public and we have people visiting from just the regular meetup platform. And that's why if you join the Investors Club, at that point, we're able to freely share all of the details about the project.
Right, and the Investors Club members always are the people who see the deals first.
Yeah.
So that is a benefit of having the opportunity to receive the first position.
Yeah.
Great. So Tom, why don't you kick us off about the project that we're going to be talking about and using as far as our case study. This is obviously a real life project as well. So real numbers, real example, and everything about it.
Yep, sounds good.
Yeah, absolutely.
And so this one is, it's one of our 3-phase developments where we've talked about this in the last, I think maybe on both of the last calls that we've had the last 2 months, but where we do deals in phases or stages. And that is with development properties, there's taking it from raw land through to entitlements where it's basically shovel ready for horizontal development. And then that's one strategy. The second strategy, so we're sort of stacking these strategies. The second one in this particular project is to do the horizontal portion of it, which is taking it from entitlement to the horizontal development, which just means building the roads, the infrastructure, the water, sewer, utilities, all of that. That becomes the second phase, what we call horizontal construction. And then the third is the obvious, which is vertical construction. So we like to separate these out in 3 stages because it offers more flexibility. It allows us to adjust. If the market starts going one way or the other, we can adjust accordingly when we set them up in these 3 stages. So I know there's a number of you on the call that are familiar with this because you're in a couple of our other projects that are very similar to this. So again, it's basically one project that is it's set up right now to be a 512 unit multifamily complex eventually at the end of stage 3. I don't know if we want to go through the numbers specifically.
Yeah, I think the important part to reiterate here, Tom, too, is this is just talking about phase 1 of the project, so the entitlement side of the project. And you had shared a little bit about why you do it that way. But if you want to just walk everybody through the numbers, we'll probably be referencing some of these numbers through the Q&A that we're going to do and kind of the back and forth.
Okay.
But just to walk through the important aspects. And Tom, what I would be most interested in if I was on this call is what I should be looking for when it comes down to an LTV.
Okay.
Right. So at GCA, we have standards of what we look for. It's kind of the barometer of what we say is a potentially good deal or a potentially not so great deal to be involved in. And just giving rationale behind that.
Okay, got it. So on this particular piece, it is a 15.65 acre parcel. It is being acquired. We're bringing it in at $1.1 million. And this one we were able to negotiate with our development partner. I actually did most of the negotiation on this, but able to negotiate a nice seller carryback or a seller financing on the project, which is 800,000 of that 1.1 million. They're taking that back on a note at, I think it's at 6% and a couple of years term. And so that really helps this project out, makes, there's some unique things about that helps keep the risk down just in that piece alone. It's requiring $300,000 to close, and there's about 1.9 million for getting all the way through the entitlement stage phase of it. And that sounds like a lot of money, but this takes a lot of work to do the engineering, all of the things that have to be done to bring it to that point, the surveying, engineering, getting all the drawings up to snuff for the horizontal construction. Then if we add the points and interest reserves, that's 300,000. So that's about a total of $3.3 million all-in cost for phase 1, with the value of the project estimated to be at about 8.8 million. So what Kyle was mentioning, the loan to value, that's one of the sweet things about this particular one is that the loan to value is super low on it, 38% based on these numbers. The estimated value upon completion of phase 1, that was done by a third-party broker, gave us a broker price opinion. So a lot of the things we do are done through third-party checks and balances. We'll talk later about servicing company and escrows and all of that. So I think one of the key things that I really like about this sort of a project, and we've got a couple others that are just like very similar to this. There's Hedge and there's Ballinger and a couple others that we have, and we do have a bit of room on a couple of those as well. But this, what I like about this structure is that there's no construction risk in this first phase. And the reason that's really, in my opinion, a strong benefit to this is that with construction, there's complexity. With complexity, there's risk. And so it's one of those things that we don't even have to worry about construction risk because there is no construction in the first phase. So great, highly desirable area. The demand for this is unbelievable. It's right at the edge of Sacramento in California here, but it is in the county, but it is being served by water and sewer.
I want to interject because Tom just said two really significant things that we on our side often hear. So one of the things that he mentioned is why he likes this project due to the area. So what the area is seeking to accomplish is in alignment with what this project overview is aiming toward. And for that reason, it has the potential to smooth the gears of the entitlement process going through. Further, in terms of why he likes this project, and something I always hear him saying is the less moving parts in a deal, the better, because it minimizes or mitigates the risk for things to go awry. So that's one of the reasons that we enjoy looking at the first phase of entitlement work, because going from where we are to paper lots and shovel readiness has very skilled professionals and third-party people that are doing their work, but it does help to mitigate the risk.
Yep. Yeah, and just to ask a quick question on that, Tom, too, for clarifying if anybody else on this call is when looking at that loan to value ratio, right? You would consider that pretty much your barometer gauge to understand if a project is potentially good or potentially not.
Yeah, it's one of the key indicators anyway.
Yeah, and typically what is that number that you look for as far as when you're assessing a project?
Well, our criteria is we always aim to go at 70% or less. So this one's substantially lower than that, but 70%. That way we have a 30% buffer. So if something were to go over budget or the market shifts a bit or comes down a bit, that buffer of 30% is what really helps keep the deals safer.
Great. And when I'm an investor, Tom, and I'm talking to you and asking various questions, right? A lot of this is about risk mitigation.
Mm-hmm.
And from our experience, there's really three main areas that I would say risk mitigation that we hear a lot, right? And I'm just going to run through those, and I'm curious on how you would respond to those as they apply to the loan to value ratio.
Yeah.
Right.
Just before you do that, I just want to share, see if anybody, I think we said this, but I wanted to be sure that the reason that black area is there, it's really just blacked out. Those were the terms that we had listed.
Correct.
And those,
That's right.
we'll be sending, if you're looking for more information on it, we'll be sending that out without those areas blacked out.
Great. So in terms of having that protective buffer, right? And in this case, Tom, if you say you're looking at the barometer of 70%, that gives us a 30% buffer. Almost lost you. Part of what comes into that, right, are the risks of various things. So number one, a common one that we hear is, what if the project goes over budget?
Well, first of all, the goal is absolutely for it to not go over budget. One of the things that, well, let me ask you, what would you say would be?
Well, to me, in terms of mitigating at risk, there's kind of two things. So number one is looking at an accurate budget from the beginning, right? If you're from the project side, and how do you do that, I think is the question, right? And it's getting competitive bids, not just taking one bid and running with, but getting competitive bids, comparing them, making sure that you find one that is accurate as possible, right? We can't predict everything in the future of what it's going to bring, but making sure that we approach it from the right direction.
Exactly.
Right.
Yeah, let me take the second one. The second one is having a contingency in the budget, so that anywhere from 5 to 10% contingency, I think, is pretty standard, at least for us, to have that contingency, that buffer, that if anything does go over budget. In construction, things just don't always go as planned, but luckily in this case, there is no construction budget even needed. So
great. So far, right, we have
in this first stage.
Absolutely. So 2 risks I'm hearing so far is, right, making sure the accurate budget, right, and getting multiple bids to help mitigate that risk.
Yep.
Second is building in a construction contingency of about 5 to 10%, so that if those do fluctuate at the time of construction, that's built into the budget beforehand when looking at what you have as you called protected equity.
And how does the loan to value ratio support in the event that it does go over budget?
Exactly. That would be that protective buffer of in this, well, if it's at 70%, it's a 30% buffer. In this one, this was 38%. So it is at 62% equity buffer.
Yeah. And
So
we'll-
from I'm sorry.
No worries. We'll talk about why that one is low, right? And typically a bit outside of what we see typically. But one other area in terms of risk mitigation too that we hear commonly is, what if the market goes down?
Yeah, then there is that buffer again.
And typically when the market goes down, what do you expect on average?
For it to go down?
When a market goes down, typically how many percentage points would you say it fluctuates up or down at a given time?
Well, it depends on where you're at in the country.
Yeah.
We all had a chance to see some fluctuation in market values back in 2008, 9, 10, 11,
Sure.
12, whatever. So, but you know, I think generally speaking, except for that particular event, it typically takes quite a bit for it to go down 8 or 10% even.
Yeah, and from our conversation, Tom, you know, what you were saying is basically that only a matter of a few points or a few percentages, you know, here and there in terms of a typical market
Yeah.
movement, right? So when building a 30% buffer under normal
Customers.
circumstances, right, that would protect you from anything from a deal.
Mhm.
Obviously, anything that goes back to 2008 is what I would consider abnormal,
Yeah.
certainly possible.
Hopefully an outlier.
Yeah.
Mhm. Got it. So, let's go through some of the role playing as we had talked about earlier, but not necessarily as it relates to this project specifically, but things just in general.
Great, absolutely. So to kick it off, Jacqueline and I will play the role of investor. Tom, you'll play the role of GCA and project
What?
owner.
What?
So
maybe we can shift. So yeah, let's
Absolutely.
go ahead.
So when looking at a few questions, somebody comes up to you, Tom, am I guaranteed to get my money back?
Well, no. But that's pretty much you threw a tough one there. But no, you're not guaranteed, because this investments, unless they are very specifically stated as guaranteed, there is not a guarantee. And so another way of looking at it is, could I lose my money by investing in projects or in real estate? And absolutely you can. But the key is to set things up in a way where there's a very low likelihood of that happening. And so is that the kind of answer you're looking for?
It is. You know, another concern that I have too is, you know, when I go ahead and invest money in your project, how do I know I'm going to get that money back at the end of the day? And that, you know, the borrower or whoever is not just going to take my money and run.
Got it. By the way, if anybody has questions, be sure to type them in, and we'll watch the thread here to see any questions that come in. I don't know if there are any there so far.
Excuse me for one sec. Tom, just because I can see your video, can you hear us okay? Are we projecting through to the computer in such a way where we're crystal clear? Okay, thanks for checking in.
Perfect. Thank you.
Great, thanks.
Okay, what was the question?
So you're not going to take my money and run away from me, are you?
Oh, right. Oh, yeah. So what are some ways that as passive investors, we want to make sure that the active investor doesn't walk away from the project? I think that's kind of what you're asking. The way we handle that is all funds go into third-party escrow. They're handled by, for us, it happens to be Good Stewart Lending Services does most of ours, but there's a third-party escrow that holds all the funds, anything as it relates to renovation, to the rehab, or even new construction. The funds are held in escrow. The borrower does not have access to those funds at all until the inspections have been done and photographs have been taken. And it's basically the short answer is third-party escrow and third-party money control. where the active the active investor or the borrower just does not have access to those monies.
Great.
And then the documentation supporting that escrow account has it such that people can only pull funds in accordance with the operating agreement.
Exactly. Well, the escrow agent has control of that, and that escrow agent is instructed by way of escrow instructions from the lender, from the investor.
So for a passive investor to stress test the deal or test the team, having a third-party escrow account might be something that you could look for. And if you're on the active side, ensuring you set up one increases the likelihood that you'll allow the space for peace of mind on the perspective of the active passive investor.
You just don't want anybody walking away with the money or any funny things happening with the money. And that's why having that third-party escrow is super important.
Great. You know, as an investor, I've invested in a number of projects. Typically, the two most common models that we see are fix and flip, right, and a buy and hold. So when I'm looking at different projects, Tom, what should I be looking for? Short-term investment or a long-term investment?
My answer to that would be, it depends on what you're looking for from that investment. The reason that we like focusing on shorter term projects where there is what we call forced appreciation or a forced value in the project over a short period of time, it allows us to structure the deal so that the active investor is very happy with or comfortable with the cost of money because it's a short term situation, and the passive investor is happy because they get to share in the profits and the upside. So the returns can be higher on those shorter term deals. Longer term deals, on the other hand, typically don't offer that sort of return because you don't have that kicker or that bump from that forced appreciation from the work that's happening on the project. So it really depends on what you're looking for. There are some investors who are very happy with 4, 5, 6% return on their investment over time, and that's totally fine. And it's a matter of a long-term plan. Maybe they ride some of the equity appreciation of the project as it goes, but there's also investors who like the shorter term investment where it does have some of the higher potential because of that profit share component.
Great, that makes total sense. Go ahead, Jacqueline.
So just to elaborate on what Tom said there and keeping Kyle in the role of role playing, a lot of what Tom said reflects the overall model and the deals that we like to participate in at GCA. There's shorter term investments overall and allow therefore the potentiality for those sorts of returns. Sometimes when we have Kyle, the would-be investor, specifically looking to explore some of our projects, we could play the consultant role and support Kyle to figure out what deal most supports his appetite for the timeline. So if someone is just coming in, having one of the short deals on our end in maybe 6 months could be a really great starting place for Kyle in this case, if he's never invested with us before, because he would get to go through the full deal cycle and have immediate feedback about what the full process is. So for those of you who are active, that might be a good possibility. However, for experienced passive investors, to create more efficiency of the capital and receive a potentially similar return because your money is still at play in a deal, some people have an appetite to have 12+ month term, up to 2-year terms, or roll over into different phases of the different real estate investment strategies, entitlement, horizontal, vertical, such that they maximize the efficiency of the capital. So if you're passive, you can consider where your appetite is. And if you're active, you can support people to understand what their ideal deal is, so they're making the best choice with their funds.
Great. So I personally have an appetite. I don't need my money out in 6 months. I'm willing to keep it in for say 24 months. Why wouldn't I look at maybe 4 short-term deals instead of holding my money for 2 years?
I'll answer.
Yep.
So it's really about capital efficiency, and you could completely do 4 short-term deals and then access the liquidity of the capital so you could pivot and decide what you wanted to do with that at that time, and that's just fine. Should you choose a medium to long-term deal or opportunity, then your money's always working for you during that time because there's never a lull in the annualized rate of return during that period. Does that make sense?
I got you. So what you're basically saying is if I found an opportunity, it was a short term, it was 6 months, the likelihood of me doing 4 6-month projects back to back to back to back is very low, right? Given the time to invest, the time to start up, things happen in the project.
Paperwork.
So if I was willing to hold my money in there for 2 years, it would make sense for me to keep it there for those 2 years rather than doing multiple short-term projects because of that time that I would lose in between every deal.
Another way
that
of
fair?
saying that is that the capital efficiency is higher because you don't have any downtime from the space in between making decisions on the different investments. So yes.
Great, great.
Cool.
What happens if the project doesn't go according to plan? How do I know that you're going to stick around through completion?
Well, let's identify who I am. So I think we should put this more in the context of a borrower or a developer.
Great.
If we go back into the role play, I am a borrower in this case. Is that
Correct.
what you're
Yep.
saying? So what was the question?
How do we know that you're going to stick around, that you're not going to let this project fold on itself if things start to go awry?
Yeah, got it. I'm going to have skin in the game. I'm going to have skin in the game that if I walk away from the project, I am going to lose something. And that means I'm going to either have put cash in myself, or I'm going to have put cross collateral property up myself, or I'm going to have brought in a collateral partner. There's a number of different ways to bring skin in the game to the deal, but that's how you keep their attention when they're working on if they are a borrower, or if you're a borrower yourself. Anyone on the call, the key is really to be able to show that passive investor with the money how you plan on how you're going to prove to them that you will stay with the project.
And what's an appropriate amount of skin in the game would you recommend for a borrower to put into a project?
We like to see 10 to 15% too.
Okay.
So that's if let's say that the investment is let's say it's $500,000, then 10 to 15% of 500,000 would be 50 to 75.
Okay. What about me, Tom? Say that I have something other than money, right? I can swing a hammer, I can fix up a home. I've done a couple of fix and flips of my own. Can I put labor in as a skin in the game?
You can put labor in, and you can get the way we set it up, and the way I recommend you set it up is you can put labor in. You can structure it however you want that way, but we do not want to see that as considered as skin in the game. And the reason for that is that if you are, let's say you're doing the deal, you're working on the project, all of a sudden something starts to go sideways on it, and you found another project that's nicer, sweeter, better than this one that you happen to be working on, and it's only your labor that you put in, and well, maybe you might just figure it makes more sense for you to walk away from it than to finish it up. So that's one reason. The other reason is that you always want to make sure that when you're budgeting for labor or for any of the items that are needed on a project, it needs to be done at full market value, because what happens if you're working on the job and you bust your leg and you can't do whatever is left to do? Then all of a sudden that has to be hired out, or the project stalls out. If it has to be hired out, where does the money come from? Well, oops, that wasn't allocated for. So now what? Project is stalled out anyway, unless you're ready to, you have an investor that's ready to put more money in it for you.
Great. So even if you or me, right, are able to do the work in the project, you're basically suggesting to allocate it in the budget as if it was a third-party builder.
Yes.
Correct?
Yes.
Okay.
And also have 10 to 15% skin in the game that's not related to that.
Okay.
Two significant ways to mitigate risk there for both sides of the equation to ensure that the people who are enacting the deal have something to lose. I saw a question in here from Reginald, so I want to just
Please.
present a couple questions in there. Reginald's question was, what's the timeline on this sort of project? So I'd like you to answer that just around Florin Road, just so you have something to talk about. So a would-be investor says, what's the timeline?
Well, as an example, this particular one is 18 months is what's anticipated for this full first phase of entitlements to get it from where it's at today to fully entitled. And I think that it's a little bit longer than some, but that's because this particular property is still, it's in the process of being rezoned. And that rezoning takes a bit of time. But I would say entitlement process, and feel free, anybody, if you have any other comments on this. I know, Terriel, you're a developer. My experience is 12 to 24 months is typically the range for entitlement processes.
So I want to push a little bit more there. If I'm an investor or I'm seeking to invest, so it's 12 to 18 months as far as the timeline for the project. When do I get my money back?
Well, in a project like this, if it's structured like this one is, at the end of phase one, if it's 18 months, that's when investors would get their capital back. There's a slight chance that there might be an exit prior to that. We do have, and this gets too much in the weeds, but we have a couple other options for exit a bit early. But yeah, it would happen at the end, and the funds, investors would have the option to either get paid out or they may want to go into the next phase.
Roll over into the next phase. So I wanted to double click on that from a timeline perspective. Some investors who are just getting started might see a graphic like we showed earlier with the full apartment complex on it and consider the timeline to completion between breaking ground or acquisition of the property through high rises built. And so the timelines that we're looking here, that we are looking at and that we like working with, they're done in tranches. So it's entitlement, horizontal, vertical. So you might say in response to what's the timeline on this kind of project? Well, this phase is 18 months. And you have the opportunity to, or you could potentially have the opportunity to roll over or follow on after that point. And right now, although that's really far away and we don't have those terms in pocket, what we can say is that could potentially be another year and another year after that. So you have the option, there's plenty of points to receive liquidity.
Yeah, and I think looking at this again, just for anybody on here, whether again, you're an investor looking to invest money or you're the ones who are in Tom's place, right? Like a borrower. This is a great way to look at structuring.
I'm not a borrower, except for this example.
Sorry. Structuring deals. I was still in the role play. You know, when looking at structuring a deal this way, it creates those stopgaps, right? So instead of bringing the entire project out over a large span of time, it gives you the ability to take a breath, pause, and decide if you want to continue forward. And basically the investors that risk and invest alongside of you have the opportunity to not risk through the whole project, but through phases of that project.
Anybody have any questions that we can answer at this point? Feel free to raise your hand or type them in the chat.
So Tom,
Terriel, just
go
one
ahead,
quick thing,
please.
said, I like that point, Tom, the on market price to budget the work. And so I just wanted to re-presence that. Not only could that have an aim for more accurate projections of what the actual estimation is, but I really like that Tom always ensures that there's a substitute for any contractor. So we're not relying on having a connection or a person in the network that makes the deal any better. That can make the deal sweeter, but as far as a would-be investor, we want to ensure that the numbers work independent from connections, network, or market drivers. The numbers get to work. Everything else is just an upside.
Okay. As far as, let's stick on the timeline space. Do we have a question?
We are at quarter to the hour.
What is the minimum needed expected to get an invitation to the Elk Grove dance? I don't know what that means.
I think what they're asking is what's a minimum investment. I hesitate to answer that only because I don't want this to be perceived as soliciting. But what I can say is that one of our ranges, we like to say a minimum of $50,000. So whatever, if you're doing your deals, that should be one of the criteria that you pick is what is the minimum investment or what's the maximum investment, setting the criteria. But in our case, ours typically is a 50,000 minimum.
And why, Tom? Why would 50,000? Why would it not accept typically lower than that?
It's really a matter of logistics and is it worth? I mean, we want to make sure that someone has the funds available to do it, and we don't want to be working with someone's last dollar or that's just a number that we've found to be a good reasonable number.
Great. Sticking on the timeline aspect, right? I think a common question that, again, we hear all the time is what happens if the project takes longer? So we're going to put this in general sense, right? Outside of what this deal is.
They do. A lot of times they do. I can tell you some experiences of some of the existing, we still have projects that have taken far longer than we ever anticipated. The downside of that is that they just hadn't completed as fast as we wanted. The upside of it, the silver lining is the lessons that we've learned from that and the fact that we've shifted a number of our strategies to help ensure that we can keep our active investors or borrowers more on track with the timeline.
Great. And what happens to my money personally, right? So say we're just going to use a blind example. Say the project was slotted for a 12-month completion. Say it went over, about another year.
Mm-hmm.
What typically, how would you recommend the people on the call structure the deal so that it still incentivizes investors if the project does go over?
Got it. And I think where you're going with this is the difference between an annualized ROI and a cash-on-cash return. I know we talked about that earlier, so I think that's where you're going. By doing an annualized ROI, that just basically means that if it takes 6 months or if it takes 12 months or it takes 18 months, it is, let's use an example, 10% ROI or annualized ROI. So if it's cash on cash and it's 10%, or let's say that number is, well, let's say it's 10% cash on cash. If it's 6 months, it's 10% of the money you've invested. If it's 18 months, it's 10% of the money you invested.
Great. So pause. So on cash, the time doesn't matter, basically. So if I'm going to get a 10% return on my investment, the project could finish early, the project could finish late. I will still, regardless, get a 10% return.
That's correct.
So then what's the opposite alternative to doing that?
The annualized ROI.
And explain that one more time.
That's if it takes 6 months, it's 10% of the amount you invested on an annualized basis.
Right. So to put that in an example, let's use the same scenario. The project was due to be completed in 12 months. My annualized rate of return that was expected was 10%. And say the project went a year over, my now annualized rate of return becomes 20%.
Your annualized rate of return stays the same.
But my total, thank you, Jacqueline, my total return ends up being 20%. Does that make sense to everybody?
Yeah, I'm guessing that, I'm guessing most people on the call will catch it.
Great. Okay.
Any other questions you want to throw at me?
While Kyle's looking, I just want to remind you guys, if you want to ask in the chat, this is any question that you might have needed support answering or something that you are curious about if you're putting money in a deal, and just seeing how Tom responds to the different questions that get thrown at him or us as well. So just encouraging, if you have any questions or there was something that came up that was a sticking point, now would be a great time.
We also talked about a hot seat. I don't know if anybody, we should just mention that if anybody on the call is interested, the first 2 months ago, we had the hot seat, and I think Caleb was on that. Caleb, are you on the call today? I can't see your, I'm not sure if you're on.
There it
think-
is. Oh, right.
All right, there we go. Cool. Good to see you. I hope your project is going well. Hopefully you got my message today. But if anybody on the call has any interest in being on the hot seat, basically it just means maybe you're looking at a deal, you're caught up, there's some challenge with something's not going as planned, or maybe you have a question about how to structure deals. Certainly, I'd love to be able to help out any way I can. And Alex, you're on the call too. Alex, my business partner, is on the call. If you, I don't know if you have anything you want to share. We've got a pretty sweet project going on in Napa Valley. So if you want to do a haves and wants on that, or if you have any comments to add, certainly feel free to jump in. So
Great. Okay, so we have one more question for you.
okay.
Would you sign a tolling agreement to extend the time of the overdue project? Kathy asks.
A tolling agreement. I haven't heard it being used as that term, but I'm guessing what's meant is, would it be basically a what do you call it? Not a repositioning, just basically an extension of the note.
Like a renewal?
Yeah. Is that what you meant on that question?
Kathy, let us know if that's the case, if that's what you meant, extending or having a renewal. So Tom, would you do something like that if there was an overdue project? A renewal agreement or an extension in writing?
Yeah, no, it depends on what hat she's referring to. So like, for instance, with our investors, it automatically happens that let's say it's estimated at 12 months and it goes to 18 months. It's automatic. It doesn't require any additional documentation because that's already built into the documents. If it's with a borrower, then yes, so it would need to have some sort of an extension built in.
Great.
Okay. So any other questions, any hot seat items, anything, any feedback on what you're hearing? It would be interesting to hear if we're hitting the mark here on things that are helpful. We want to make sure that we're bringing value to everyone on the call, and that we create a collaborative space where people can work together. Again, if you want to get a recording of this call, or you have any information you want to share, the best way to do that is just to jump on. Kyle or Jacqueline, what's the link? How do they get to the Investors Club?
We'll drop it in right now.
Sign up. That's going to be the best way to have easy access to us and be able to get the details on any particular projects that we might have coming through.
Yeah, great. And so awesome overview. There were a couple more responses came in that while you were communicating there. So Alex just clarified, a tolling agreement is a written agreement signed by both sides to a potential lawsuit, and then continued, the intention behind a tolling agreement is to avoid losing a right due to a statute of limitation. So thank you, Alex, for that reply.
Alex.
Yeah.
Thank
And David asked, will you sponsor the development with GCs vetted or sell the entitlement? So I think that's a specific question as it relates to Florin Road. Do you want me to read it again?
Yeah, and just the first half.
So David said, will you sponsor the development with GCs vetted or sell the entitlement?
Oh, got it. If you're referring to this project, Dave, we have this one set up with the intention of going to stage 2, but with the absolute ability to exit at stage 1 if that's what we and our developer partners want to see. So could you just let us know if that answered your question?
I think that was great. And I think a really great potential investor question, assessing whether or not the deal has flexibility, if there is a pivot point, and what the trajectory of the rest of the deal is. So great question, David. Is there anything, Tom, you wish Kyle and I would have asked you that we didn't, to illustrate the most common questions you get from investors?
I think, I can't think of anything else. I mean, there are tons of questions. We're actually, Jacqueline, Kyle, and I have been working this week on putting together an FAQ that what we want to do is be able to, it's probably going to be about 30 questions, FAQ questions that I want to get put on our Mastering RE website so that, and that'll be a really good resource if you're in the market, if you're looking to be a facilitator or you're an active investor looking for money and talking to passive investors, or vice versa, if you're a passive investor looking for active investors. That we want to do it in a way so it's a great resource for you to really be able to help for you to trigger questions that should be asked. There's always a term of FAQs, which is frequently asked questions. I always think there should also be an SAQ, which is a should ask questions, the ones that we don't necessarily always think of. And so that is our goal, is to get that within the next month or two, is to get a good solid list of FAQs and SAQs on our website. And we'll be sharing that with you as soon as we get that done.
Right. And I think, from our perspective, that's something that, is consistent clarification, understanding, getting people on the same page of those questions prior to jumping on a call. Typically, when we jump on a call to talk about any particular investment or to work through those, the idea is clarity, right? So it's so much looking to cut out as much as possible beforehand where people can investigate themselves. And that's a recommendation for anybody on this call as well. Again, if you do have projects, making sure that there is some sort of prep document prior to the call that can answer a lot of these. So you're not spending most of the call answering these questions, rather talking about what's right for the investor, right? And as from an investor, talking about what's right for you. So it's a mutually collaborative, at least, when we jump on the phone, and getting a lot of these answered ahead of time makes our calls more productive.
And that resource that Kyle's referring to can be either called a due diligence package or a credibility kit, and then a deal summary as it relates to the specific deal. So David elaborated a little bit more, just added a little bit more from his last question about the GCs or selling after the deal, and was referring to the bullet in the Florin Road document. He continued that he saw the no risk construction bullet and wondered what that was about as it relates to the Florin Road project. So I'm going to take that and then you bolster my reply. So one of the reasons that we like entitlement.
Clarification, we did not say no risk, right?
No. We didn't say no risk. You said no construction risks.
Right.
So actually, let's start there.
So with that in mind, feel free to take that.
So I want to actually start with what Tom just corrected me on. That's so important, and he's constantly like flicking in a very educative way to ensure that from an SEC perspective that we never say guaranteed, that we never say no risks. But
and literally speaking, there is no project that has no risk.
Correct.
The only reason that this one says no construction risk is
it's
that
because there's no construction. So it's very literal.
So,
there's no construction risks on this project.
Yeah.
But why we like projects like this is because it eliminates moving parts in the entitlement phase. So that's all that is referring to.
Did that help, Dave?
Gabriella says, I don't always see all the updates on your website. So one way that you can ensure that you're getting updates is by ensuring that you've signed up for the Investors Club, which we put that link right up there. We send all of the first look at deals or any new notifications to that group specifically. And because we're talking about compliance, it's frankly because we've illustrated substantive contact to that group, so we can say a lot more than we can on our website or to our whole list.
Yeah, and I think what Gabby might be talking about is she's invested in a couple of projects, and we have an investor portal that has for investors, for our current investors that are in projects, we have an investor portal where we post updates. So we'll catch you offline on that to make sure you have the access that you're looking for. I'm thinking that Lisa I had sent something a while back, but let's follow up on that later.
Fantastic.
I had one more point that I wanted to just bring up before we move to wrap. Some of the time we have questions on market drivers, or like in this case, the data on Sacramento that illustrates that it is an in-demand area with a low supply of affordable housing or just housing in general. And so documentation that supports the SB 90 in the way that the government is looking to support these kinds of projects, as well as data on the area. So often how we'll handle that is, rather than going over all the stats on the call, we'll make the broad strokes like I just did, and then follow up with a really clear report in writing that illustrates all those elements and how they're substantiated. So that's a resource that you could have on hand, or if you're someone looking to invest into a deal, it's just one more thing you can ask for to mitigate the risk. Mitigation is our new conjunction of that word. And that's something you can ask for that can just give you more peace of mind.
Okay. So anybody have any last comments they want to share here? Otherwise, we can wrap this up.
Yeah, as we're wrapping, I'm going to drop a calendar.
Yep.
So again, if you're in the Investors Club already, you are going to receive this deal summary without the blacked out parts. And then if you choose to, you can set up a call to explore it more deeply and what works for you. If you have any other questions, or you are seeking to talk to us about the deal and you're not in the Investors Club, I'm just going to put a link in the chat right now. And so you're welcome to go ahead and book a call with us if you're seeking to explore what's the next best step for you.
So, cool.
Anything else? Are we ready to wrap?
Ready to wrap?
Yep. If you guys have any questions that you want to take offline at all, just feel free to reach out to me. Any one of our team here will be that we're here to support. Even if it's something that you're working on that's totally separate, that we're not involved with, we're always happy to help out and support you in any way that we can. And I guess that's it. So until next time, happy and safe investing.
Indeed.
So,
We're so grateful for your presence. Thanks for being part of this community.
Thank you, everybody.
bye,
Cheers.
guys.